current price of Dell Technologies is $129.98 USD, down 8.62 points or 6.22% on the intraday session. We are watching a significant bloodletting in the hardware sector today, and if you are holding Dell, you are feeling the immediate impact of a market that has suddenly decided to shift its narrative from growth at any cost to show me the margins. A 6% drop in a company with the capitalization and industrial fortitude of Dell Technologies is not a simple fluctuation. It is a statement. It is a repricing event. The market is effectively shouting that the expectation of infinite AI-driven revenue has collided violently with the reality of hardware unit economics. But before you panic sell or aggressively buy the dip, you need to understand the precise mechanics of what is happening right now, because the headline number of $129.98 is hiding a much more complex story about the future of enterprise infrastructure. The expectation for Dell, and indeed for the entire basket of AI-adjacent hardware stocks, including NVIDIA stock, was that the sheer volume of orders for AI servers would act as a rising tide that lifts all boats indefinitely. The narrative sold to retail investors and institutional allocators alike was that we are in a supercycle where demand is inelastic. The reality, however, is revealing itself to be far more nuanced and, quite frankly, more painful in the short term. The reality we are seeing play out on the charts today is that while revenue is growing, the cost to generate that revenue is climbing even faster. We are seeing a classic margin compression event. The cost of components, specifically NAND flash memory and DRAM, which are essential for these high-performance AI computing units, is skyrocketing. Dell is selling the servers, yes, but the cost to build them is eating into the profit slice that investors were banking on. This tension between the AI supercycle expectation and the margin compression reality is exactly why we are seeing this red candle today. When we look at the broader market context, this move in Dell isn't happening in a vacuum. It is critical to observe the sympathy moves across the board. Just as Tesla stock often moves in lockstep with sentiment regarding EV adoption rates and interest rate expectations, and Apple stock acts as a proxy for the health of the consumer wallet, Dell is currently trading as a proxy for enterprise AI capital expenditure. The market is jittery because we've seen recent reports from peers like Oracle and Broadcom that suggest a similar theme. The infrastructure build-out is happening, but the monetization curve is longer than the hype cycle suggested. If you are an investor using Schwab Intelligent Portfolios or managing your own capital through an individual brokerage, you might be seeing these alerts flash across your screen and wondering if the thesis is broken. The thesis isn't broken, but it is being stress-tested. The drop to $129.98 pushes the stock into a critical technical zone. We are testing the resolve of the bulls who entered during the last earnings run-up. Let's break down the trading activity we are seeing today. Volume is elevated, significantly higher than the 10-day average, which indicates institutional distribution. This isn't just retail traders on the Robinhood app panic selling their Robinhood fractional shares. This is heavy volume-weighted selling pressure that suggests large funds are trimming exposure to manage risk. When you see this kind of coordinated selling, it often triggers algorithmic selling cascades. If you use Interactive Brokers trading platforms or have a pro-level Interactive Brokers account, you can likely see the depth of book showing bid support evaporating at the $130 level, which has now been breached. The psychological importance of holding $130 cannot be overstated. Closing below this level could open the door to a test of the $120 region, a region that many technical analysts would view as a potential accumulation zone, but one that feels like a free fall when you're in the middle of it. For the individual investor, the landscape has never been more accessible, yet more treacherous. Whether you are engaging in online investing through SoFi Invest or utilizing Fidelity Wealth Management services, the tools at your disposal are powerful, but they require a cool head. It is easy to get caught up in the gamification of investing sites where red and green flashing lights dictate your emotional state, but successful self-investing requires stepping back and looking at the business fundamentals. SoFi stocks and SoFi ETFs users often see these dips as immediate buy signals, but professional traders utilizing interactive brokers trading tools will look at the implied volatility and wait for stabilization. The divergence in behavior between the retail crowd on Robinhood stock trading forums and the institutional flow is stark today. Retail is asking, "Is this the bottom?" while institutions are asking, "Where is the margin floor?" Let's shift the focus to the company itself. Dell Technologies is not just a box mover. While the legacy perception of Dell is that of a PC manufacturer, a low-growth, cash cow business, the modern Dell is an infrastructure beast. They are the plumbing of the internet and the backbone of the AI factory. The business model is split largely between the Client Solutions Group, which handles the PCs and laptops you see in every office building, and the Infrastructure Solutions Group, which is the engine of growth we care about today. The ISG is responsible for the servers, storage, and networking gear that power data centers. The excitement around Dell for the past year has been entirely driven by the ISG division, specifically their AI-optimized servers like the PowerEdge XE9680. These machines are absolute monsters, designed to house the coveted NVIDIA GPUs that are training the models of the future. However, the reality hitting the stock price today stems from the fact that selling these AI servers is expensive. To build an AI server, you need expensive HBM memory, expensive cooling solutions, and expensive GPUs. Dell acts as an integrator. If the cost of those components goes up, which it has due to supply constraints in the memory market, Dell either has to pass that cost to the customer or eat it in their margins. Today's price action suggests the market believes Dell is eating some of that cost. Furthermore, there is a looming concern about the backlog. Dell has a massive backlog of orders, which sounds great, but if they can't ship those orders fast enough due to component shortages, or if they ship them at lower margins, the backlog becomes a liability rather than an asset. In contrast to the high beta moves of NVIDIA stock, Dell has traditionally been viewed as a more stable, dividend-paying value play, a stock you might find recommended in Fidelity mutual funds or stable Fidelity IRAs, but the AI narrative has injected a level of volatility into Dell that makes it behave more like a momentum tech stock. This identity crisis is part of the problem. Value investors are scared off by the volatility, and growth investors are scared off by the margin compression. It's caught in the middle. This is why you see such violent repricings. When a stock like this falls 6% in a day without a specific company-issued disaster news, it's usually a sector-wide realization or a macro-driven rotation. Speaking of macro, we have to consider the environment. We are in a period where interest rates are a constant overhang. For a company like Dell, which carries debt and relies on corporate capital expenditure cycles, the cost of borrowing matters. If the Federal Reserve signals higher for longer, CFOs at major corporations, Dell's customers, tighten their belts. They delay that server refresh. They push back the PC fleet upgrade. This macro pressure is the invisible hand pushing the stock down. You might be checking your Fidelity mobile app or your Robinhood cash management balance, wondering if you should deploy cash. The answer depends on your timeline. If you're looking for a quick flip, catching a falling knife like this is dangerous. If you're looking to build a position for the next 3 years, the analysis changes. We must also talk about the PC cycle. The Client Solutions Group, CSG, has been in a slump. The post-pandemic hangover meant that everyone who needed a laptop bought one in 2020 or 2021. Those machines are now aging. The expectation is that the launch of AI-enabled PCs and the Windows 11-12 refresh cycle will trigger a massive wave of buying in late 2025 and 2026, but reality is that we haven't seen it show up in the numbers yet. The market is tired of waiting. It wants proof. Until CSG shows a return to growth, Dell is flying on one engine, and if that engine sputters, the plane loses altitude. This is what we are seeing at $129.98. I want to pause here and ask you a question directly. This drop is painful, but it also tests your conviction. Comment below how many shares of Dell Technologies you currently hold, or if you are looking to enter a position at these levels. Are you a long-term believer in the Michael Dell turnaround story, or do you think the legacy hardware business is a drag on the AI potential? Let me know in the comments. Continuing with our analysis, let's look at the investment landscape. For those of you utilizing online investing tools, you have likely seen the proliferation of robo-advisors. SoFi Robo-Advisor and Schwab Intelligent Portfolios are designed to asset allocate based on risk. On days like today, these algorithms might be rebalancing. If Dell's volatility spikes, it might trigger automatic selling in volatility-controlled funds, exacerbating the move. This is the hidden plumbing of the modern market. It's not just humans making decisions.